For most of your life, you were told one simple rule: save your money, put some aside, build an emergency fund, be responsible, do not waste. If you save, you will be safe. That is what parents taught, that is what teachers taught, that is what banks taught, that is what financial advisors taught, and for a long time, it was true. People who saved were protected, people who saved slept better, people who saved had options. But something changed, quietly, slowly, without announcement. Today, saving money does not protect you. It slowly destroys you, not in one dramatic moment, not in a crash, in silence, every day. Most people do not notice it happening. They only feel it later, when their savings feel smaller, and when their safety net feels weak, when emergencies feel heavier, when retirement feels impossible. Imagine this. You save $500 every month. You do it for 10 years. You sacrifice. You skip vacations. You skip pleasures. You say no to things you want. After 10 years, you feel proud. You built $60,000 on paper. Now look closer. Inflation averaged 4 to 5%. Your bank paid you 1%. Every year you lost value. After 10 years, your $60,000 buys what $40,000 used to. You did everything right and still lost. Nobody warned you. Nobody apologized. It just happened. Now look at savings accounts. Most pay almost nothing. 0.5%. 1%? Sometimes less. While prices rise 5, 6, 7%. That gap is your loss. That is money being taken from you, legally, systematically, relentlessly. And here's the worst part. Banks make money from your savings. They take your deposits. They lend them out at 5%, 7%, 10%. They profit from your discipline while you fall behind. Saving used to mean safety. Now it means exposure, because cash is the weakest asset in the system. It is designed to lose. Governments inflate it. Banks exploit it. Markets outrun it. Yet people are still told, just save more. As if effort can beat math. As if discipline can beat structure. It cannot. And the people who know this do not keep their wealth in cash. They move it. They protect it. They multiply it. While regular people are encouraged to park money and watch it shrink, in this video, you will see why. Why the safest strategy of the past is the most dangerous illusion of today. When you put money in a bank, you think you're doing something smart. You think, my money is safe. My money is protected. My money is waiting for me. That is the story. The reality is very different. Your money does not sit there. It gets used immediately. The moment your paycheck hits your account, the bank starts working with it. Not for you, for themselves. Banks operate on a simple model. They borrow from you cheaply and lend to others expensively. You give them money at 1%, they lend it at 6, 7, 10%. That difference is profit, massive profit. And because millions of people deposit money, banks control enormous pools of capital, trillions. They use it to finance corporations, governments, real estate, speculation. Your savings become fuel while you earn crumbs. Now think about risk. Who takes it? Not the bank. You do. If inflation rises, you lose. If currency weakens, you lose. If purchasing power drops, you lose. The bank still gets paid. They are protected through regulations, through bailouts, through central bank support. You are not. Then comes the illusion of safety, deposit insurance, government guarantees. It makes people comfortable. It makes them passive. They stop questioning. But insurance only protects the number in your account, not what it can buy, not your future, not your standard of living. You can be insured and still become poorer, slowly. Then there is liquidity. Banks love deposits because they are flexible. They can move them instantly, shift them, reallocate them, leverage them, while you wait months for approvals, days for transfers, hours for access. Your money becomes their tool. And here is something most people never consider. Banks need you to save. Without savers, they collapse. Without deposits, they cannot lend. Without lending, they cannot grow. So they promote saving, they advertise it, they celebrate it, but they do not reward it. They reward borrowing. Credit cards, loans, mortgages. Debt is where real profit lives. Savings are just raw material. You are supplying it for free. And once you understand this, the relationship changes. You stop seeing banks as guardians. You see them as intermediaries, middlemen, extractors. And in the modern system, middlemen usually win. If saving money is so important, why do the wealthiest people avoid holding cash? Why do billionaires keep only small amounts in bank accounts? Why do major investors move money constantly? Why do large corporations park funds and assets instead of savings? It is not because they are reckless. It is because they understand something most people never learn. Cash is a melting ice cube. Every year it shrinks, quietly, predictably, relentlessly. So people with financial education treat cash like fuel, not storage, something to use, not something to keep. They hold just enough for flexibility, emergencies, opportunities, timing. Everything else is placed where it can grow or protect value. Stocks, real estate, businesses, bonds, commodities, private investments, even during uncertainty. They diversify, they hedge, they adapt, because they know that sitting still is losing. Now look at regular households. Most wealth is in cash, checking accounts, savings accounts, low yield funds, money that earns almost nothing. While prices rise, so wealth slowly transfers upward, not through theft, through ignorance and structure. Here's another secret. Wealthy people borrow strategically. They use debt to acquire assets, assets that produce income, assets that rise with inflation. So while inflation hurts savers, it helps asset owners. Their properties rise, their stocks rise, their businesses raise prices, debt becomes easier to pay, cash holders fall behind, asset holders move ahead. This is why financial gaps widen, not because rich people work harder, because they play a different game. A game most people are never taught. And when regular people try to copy without understanding, they fail, they buy at peaks, they panic sell, they chase trends. Because nobody explained risk, nobody explained cycles, nobody explained patience. The wealthy protect capital first, growth comes second, survival comes before profit. Most people do the opposite. They chase returns, ignore protection, hope for luck. And hope is expensive. So over time, those who understand cash avoid it. Those who trust cash depend on it. And that difference compounds, year after year, decade after decade, until two worlds exist, one protected, one exposed. Most people think governments protect savers. They believe leaders care about responsible citizens. They believe saving is encouraged, rewarded, respected. In reality, modern governments quietly depend on destroying savings because they are drowning in debt. Almost every major country today owes more than it can realistically repay. Trillions, sometimes tens of trillions, and there are only three ways to deal with massive debt. Raise taxes, cut spending, inflate it away. Raising taxes is unpopular. Cutting spending causes backlash, so they choose the third option. Inflation. When money loses value, debt becomes easier to pay. If a government owes $1 trillion and the currency loses half its value, that debt just became cheaper in real terms. But what happened to your savings? They lost half their power. You paid the price without voting, without discussion, without consent. This is called financial repression. It sounds technical. It is brutal. It means keeping interest rates low while inflation stays high. So savers lose, borrowers win, governments win, banks win, asset owners win, you lose. Look at interest rates. For years, they were near zero, sometimes below inflation. That was not an accident. It was policy, designed, maintained, protected. Why? Because low rates encourage borrowing. More borrowing means more spending. More spending means more growth, on paper. But it also means more bubbles, more instability, more dependence, and savers get crushed. Then there's money printing. When governments run out of funds, they create new ones through central banks, through bond buying, through stimulus, through emergency programs. Each time, more money enters the system. Prices rise, your cash weakens. They call it supporting the economy. And what it really means is shifting pain from institutions to individuals, from corporations to families, from balance sheets to grocery bills. And most people never connect it. They blame stores. They blame landlords. They blame employers. Rarely the system. That is convenient. Because confused citizens do not resist. They adapt. They lower expectations. They accept less. They normalize struggle. And policy continues, year after year, cycle after cycle. Then comes retirement. People are told, save for your future. They do, for decades. Then inflation erodes it. Healthcare costs explode, housing costs surge, and suddenly, a lifetime of discipline feels inadequate. Not because they failed, because the rules shifted. Again, this is why relying on cash is dangerous. It ties your future to political decisions, to policies you do not control, to debts you did not create, to systems that benefit from your loss. Saving is still necessary, but blind saving is a trap. Without strategy, without protection, without awareness, it becomes slow destruction. After everything you've seen, one question remains. If saving money is a trap, what are you supposed to do? Should you stop saving? Spend everything? Gamble on investments? No, that's not the lesson. The lesson is this. Blind saving is dangerous, but strategic saving is powerful. There's a difference. Smart savers today don't treat cash as wealth. They treat it as a temporary tool. They keep enough for emergencies and peace of mind, but not enough for inflation to destroy their future. They understand that money must move intentionally. They learn about assets, study markets, and invest in things that grow over time, not shrink. They diversify and focus on building more income streams, not just saving a small percentage. They stay informed and question everything. That's their edge, not luck, but awareness. If this helped you see money differently, consider subscribing. This channel is about understanding the rules of the game